On November 22, 1963, the New York Stock Exchange shut down at 2:07 in the afternoon. Most people remember why. President Kennedy had been shot in Dallas 26 minutes earlier. But the panic on the trading floor had started 3 days before that. And it had nothing to do with Texas. It started in a New Jersey tank farm, with a man who had convinced 51 banks that he was storing 1.8 billion pounds of vegetable oil. Most of those tanks were filled with seawater. His name was Anthony De Angelis. Everyone called him Tino. He was born in the Bronx in 1915, the son of Italian immigrants, and by the time he was 40, he had already perfected the only business model he would ever need: sell people something that didn't exist and trust them not to look. In the early 1950s, he ran a meat company called Adolf Goebel. The federal school lunch program paid him to deliver inspected beef to American children. Court records from the period show he delivered uninspected meat, overcharged the government by $31,000, and was sued separately by Yugoslavia, West Germany, and the United States Department of Agriculture. He was not punished. He was forced to wind the company down. And in November 1955, with $500,000 in cash, he started again. The new company was called Allied Crude Vegetable Oil Refining Corporation. He bought a dilapidated tank farm on the Bayonne waterfront, 150 rust-streaked steel tanks built for the petroleum era, sitting empty next to the harbor. The pitch was patriotic. The United States was running a post-war program called Food for Peace, selling subsidized American agricultural surplus to Europe at below-market prices to win the propaganda war against the Soviet Union. Vegetable oil was on the list. Allied Crude would be the broker. Cheap surplus oil in, dollars out. On paper, it was a wholesome story. American crops feeding hungry continents. The Cold War, fought with cooking oil, on paper. In 1957, American Express Field Warehousing entered into an agreement with Allied Crude. The arrangement was standard for the commodity industry. AmEx would send inspectors to the Bayonne tank farm. They would verify the oil. They would issue official warehouse receipts certifying the inventory. And Allied could take those receipts to any bank in America and use them as collateral for a loan. American Express was, at the time, the most trusted name in finance. By the autumn of 1963, 51 banks and corporations were lending against those receipts. Chase Manhattan, Bank of America, Procter & Gamble, Continental Grain, Bunge. The total roughly $180 million. In today's money, just under $2 billion. And the strangest part? Nobody had asked to look in the tanks. Here is how the fraud actually worked. A vegetable oil tank in 1963 Bayonne was about 40 feet deep, taller than a 4-story building. The standard way to verify the inventory was simple. An inspector climbed to the top, opened a hatch, and lowered a weighted measuring tape into the liquid. When he pulled the tape back up, the line of oil residue on the metal told him how much oil was inside. There's one fact about vegetable oil that any chemistry student knows, but very few financial auditors think about. Oil floats on water. De Angelis filled his tanks from Bayonne Harbor, seawater, free. He then floated a thin layer of real soybean oil on top, sometimes only 2 feet of it. When the inspector lowered his weighted tape, the line came back coated in genuine vegetable oil. The certificate was issued. The tank was rated full. He went further. He built a hidden pump system that let him transfer the same 2 feet of oil from tank to tank between inspections. The same oil could be counted 6 times. Some tanks were certified by AmEx and then certified again by a second authenticator that De Angelis quietly hired. Some tanks listed in the inventory ledger didn't exist at all. The receipts for them did. There was one rule that made the entire operation possible. American Express Field Warehousing required 24 hours of written notice before any inspection. 24 hours is enough time to move oil between 40 tanks. By the autumn of 1963, Allied Crude was issuing warehouse receipts for nearly 1.8 billion pounds of vegetable oil. The actual inventory in the Bayonne tank farm was around 110 million pounds. For every 1 pound of real oil, 15 pounds existed only on paper. And against that paper, 51 banks had loaned $180 million. But De Angelis was not finished. The receipts were not the end game. They were the fuel. He was using the borrowed cash to buy soybean oil futures contracts on margin. Enormous positions, the kind of positions that move markets. His own buying drove the price up. The higher the price, the more secure the loans looked. The more secure the loans, the more cash he could borrow. And the more cash he could borrow, the higher he could push the price. Friday, November 15th, 1963. On that single afternoon, two things happened in Washington that De Angelis could not have planned for and could not survive. First, the United States Senate suspended debate on a proposed grain deal with the Soviet Union. The deal was politically explosive, selling American wheat to Khrushchev's government, and its suspension sent a shock through every commodities market. Confidence cracked. Second, on the same day, the Commodity Exchange Authority notified Allied Crude that it was under formal investigation for futures manipulation. By Monday morning, soybean oil prices were falling. By Monday afternoon, they were falling fast. The trading desks Allied had been propping up suddenly turned. Margin calls started arriving, bills demanding cash immediately to cover the losses on the futures positions. Allied did not have the cash. Allied had never had the cash. Every dollar in the operation was borrowed against warehouse receipts that pointed to tanks of seawater. On Tuesday, November 19th, Allied Crude Vegetable Oil Refining Corporation filed for bankruptcy. The liquidators arrived in Bayonne the same day. They climbed to the top of the tanks. They did what nobody at American Express, nobody at Chase Manhattan, nobody at Bank of America had done in 7 years. They looked inside. What they found set in motion a chain reaction that would, within 72 hours, freeze the New York Stock Exchange for the first time in its history. The first institution to break was a brokerage called Ira Haupt and Company. It had loaned heavily to Allied against the fake receipts. When the receipts evaporated, Ira Haupt was left with a capital deficiency of more than $18 million. The firm was insolvent. It was a member of the New York Stock Exchange. The NYSE had never had to suspend one of its own member firms before, and Ira Haupt was only the first. Behind it stood the 51 institutions Allied had borrowed from, and behind them stood every counterparty in the soybean oil market that had been buying contracts at De Angelis's artificial prices. American Express, whose subsidiary had issued the receipts, faced potential claims of more than $200 million against $130,000 in actual assets. On Wednesday, November 20th, the market began to digest the news. American Express stock opened at $61.81. Across the trading floor, the same question was being asked at every desk. If American Express had certified 1.8 billion pounds of oil that did not exist, what else had they certified? The most trusted name in American finance suddenly looked to anyone holding their stock like it might be on the way to bankruptcy. 2 days later, the panic became something else entirely. At 1:41 in the afternoon, the news from Dallas reached the trading floor. President Kennedy had been shot. What followed is one of the worst 7 minutes in the history of American capital markets. Sell orders cascaded across every sector. $11 billion in market capitalization were erased before the exchange officials, watching the tape accelerate past anything they had ever seen, made an unprecedented decision. At 2:07 p.m., the New York Stock Exchange shut down. The cause they cited in public was the assassination. The cause inside the exchange was the assassination piled on top of Ira Haupt, piled on top of 150 tanks of seawater in Bayonne. Tino De Angelis was convicted of fraud and conspiracy in 1965. Federal Judge Rainier Wartendijk sentenced him to 20 years in prison. The sentence was later reduced to 10. De Angelis served 7, was released in 1972, and lived another 37 years on the outside. American Express did not collapse, but its stock fell from $61.81 in November of '63 to $35.31 by June of '64. A 43% loss in 8 months. On Wall Street, the consensus was that the most trusted name in finance had been mortally wounded by a single subsidiary's failure to look inside a tank. There was, in the spring of 1964, one investor in Omaha who looked at American Express differently. He was 33 years old. His partnership managed about $50 million. His name was Warren Buffett, Buffett's reasoning, recorded in his letters to partners that year, was almost insultingly simple. The fraud happened in a warehousing subsidiary. The card business, the part Americans actually used every day to buy gasoline and dinner, had not been touched. The brand was wounded. The franchise was intact. He invested $20 million in American Express stock, 40% of his partnership's capital. At the bottom of the panic, by the late 1960s, American Express had recovered. By the 1970s, it was one of the most profitable holdings in Berkshire Hathaway's history. Buffett's $20 million became hundreds of millions, then more. Tino De Angelis did not need oil. He needed the world's most sophisticated financial system to believe in oil. And for 7 years, on the strength of a tape measure and a 24-hour notice rule, it did. If you want the next file, Wirecard, 1999 to 2020, 1.9 billion euros that never existed. It's already on the channel. The Capital Files. We'll see you there.